We're going to go ahead and get started on our presentation. As I mentioned, we're going to talk about multifamily investments, and we're also going to have our guest at the end of our presentation, Karen Hall. She's with UDirect IRA, and she's going to give you all the lowdown on self-directed IRAs, what you can and can't do with it. Meanwhile, we also do presentations, so if any investment groups are looking for a speaker, we'd be more than happy to talk to you. And let's go ahead and get started. Emerge Investments, just to give you a little bit about who we are, we're a privately held real estate investment company that provides investors with high yield returns. We're more of a boutique type of a investment firm, as we only buy 1 or 2 properties a year. We like to get the properties exactly how we want them, get the expenses, get the incomes, get everything fine-tuned, and only it takes us several months to get that. We don't like to bombard them with a whole bunch of things and have our conflict of working on several at one time. We also like to keep our investor pool small. We like to give personal attention to our investors, and they can always reach us anytime, so that's another thing that we have with a smaller boutique type firm. We don't mass produce anything, and this is what's kept us very popular. Some of the objectives we're going to talk about today. We're going to talk about how to invest like the wealthy investors. Even if your bank account doesn't really look like Warren Buffett, we're going to tell you how to be able to make the returns and own the high quality properties. We're going to discuss a little bit what is a syndication. We're going to talk about why now is the time to buy commercial properties. And we're going to discuss a little bit of the comparison between single family investments to multifamily investments, because there's a lot of single family people out there. So let's get moving on here. Stan.
A little bit about us and what we do around here. We currently have a little over 900 apartment units valued at over $35 million. Most of them are in Texas. We're actively looking at properties in Arizona and in Florida. We're heavy into community service, myself and Karen. I've been in Rotary for a number of years, been past president, and help them do a lot of fundraising events, which Karen is in the Lion's Heart, which is a community service group for high school kids. One of my main jobs for 30-something past years has been a commercial contractor, building high-end retail, big box retail, multifamily, hotels. So I've got the experience to go out and look at a piece of property and can tell you whether there's issues, foundation issues, structural issues that helps us in evaluating the property, where we don't have to hire somebody to go out and do a needs assessment.
Just to kind of show you some of the properties that we own, we've bought and sold several along the way, but our current inventory, we've got a couple properties here in Texas, 200 units, another area of Texas that we're looking in. These are all B-type properties that we invest in, and we'll go a little bit more in depth and describe this. And this is our most recent acquisition, Crystal Falls in Houston, 165 units.
As Karen said, this is our latest acquisition, was Crystal Falls in Houston, mid-'80s product. We purchased this for $6.5 million for 165 units, which was a screaming deal at the time, and it's already increased to over $2 million in value since we've owned it. We just recently put new roofs on it, put new boilers in it, resurfaced the swimming pool, and then some other minor things, and was able to recapture $15 a unit increase immediately. We've taken some of the units and gone through, put new faux wood floors down, new appliances, resurfaced the cabinet tops, put in some new kitchen light fixtures, and spent maybe $500 to $700 a unit. And we did this on 10 units and were able to raise our rent $75 just on those units, and got absolutely zero feedback. People want their upgraded units faster than we are willing to upgrade them. Again, this was a typical product that we purchased, mid-'80s, needs small to virtually no work on it. We like the properties that come across with cash flow. From day one, we close, we've got cash flow. We don't really go after the the huge value add where the property is 60, 70% occupied, needs a lot of work, needs a lot of tenant modification. Us and our investors like the cash flow immediately. And then on the tail end is where we value our work, and we'll show you how we can increase your value and our value as we go along through the property.
Talking a little bit how to invest like the wealthy institutional investors. Not many people can really afford to go out and buy a $10 or $20 million property, but you still want the benefits of how to do this. So this is how we can all pool our money together. You can buy a REIT quality property without getting lost in a fund. Many people that go in and buy multifamily REITs are in a fund. They don't know exactly what properties they own. They know the type of properties that are in a fund. It could have a couple of hundred properties within your fund, and you're one of a couple million people within this fund. So there's no real connection between you and a property, which is a big difference between us and the REITs. Everybody that invests in the syndication, they hold an equity position in a specific property. And I'm going to describe this a little bit further on how the LLCs are set up and how you do hold a position and how you got protection on there. We don't do any type of a blind funds. You know exactly which property you're involved in. Professional property management team is to us one of the biggest keys over there. We don't self-manage any of our properties. There's way too many government regulations and rules which you must adhere to. There's a lot about fair housing. There's a lot about evictions. I don't want to be involved in any of those type of issues. I also don't want to have to deal with the employees on the property and any type of work comp issues, hiring, firing, whereas the property management company is in charge of all the employees under your guidance. Talk a little bit about what is a syndication. A syndication, as an example, is if you want to go to Hawaii, you want to get an airline to go to Hawaii. You can't afford to buy the whole plane by yourself. That doesn't make any sense. So what you're going to do is you're going to pool a whole bunch of travelers together. The airline's going to be your facilitator. They're going to set up the route, the time, the food, logistics. This is similar to what Emerge Investment does. We find the property, we're the logistics, we do the financing, we do the due diligence, we set up all the documents, we set up the structure, and then the pool of investors, similar to passengers on an airline, jump in and reap the benefits of getting what they want to do. This is basically how a syndication works. You have a managing partner and you have the limited partners that just put in the money and someone else sets it all up and does all the management. With a syndication, it works with private investment partners like you, private individuals that have investments and they partner together on a deal. Accredited investors. We prefer to use accredited investors on all of our syndication. An accredited investor by the SEC is someone with a net worth of over $1 million or a single person with an income over $200,000, and there's a few other criteria in there. On some of our deals, we are allowed to take sophisticated investors, which is considered somebody with experience in real estate or investing, but may not have the big net worth of $1 million of the income. And there are some times when we can take sophisticated investors on specific deals. We have to work with our attorneys to make sure that everything's within the regulations on this. As I mentioned earlier, the investors, you buy into an LLC for one property. In other words, we're going to set up an LLC called Great Apartments LLC, and that Great Apartments LLC is going to own that apartment building. And when the investors come in, they're going to be part owners of that Great Apartment LLC, and that's what's going to be titled when you go to buy the property. I'll explain this even a little bit more. Everybody in that LLC has an equity position, so you are the owner of that property. We're also SEC compliant. We work very closely with SEC attorneys. We've got a couple of them that we work with, and they make sure all of our documents are filed right, and they give us all the guidance that we need to stay good and compliant with the government. It's very important to us to stay legitimate and not cross any lines at all.
Why Multifamily Now? As Karen may or may not have said in the beginning, we have nothing to sell you. We're not selling books. We're not selling courses. We're not selling you a property or anything of that nature. We're just here to inform you how either you can invest with someone like us, or maybe down the road you can figure out and get a group of guys together and go out and invest on your own. But right now is the perfect time to be investing, either buying or getting into a partnership. The mortgage rates are unbelievable. They've risen a little bit, but they're still historically extremely low. Now, in reading the past few days, it looks like the stock market is getting a little weary of the Fed's rattling the chains a little bit about stopping the stimulus money, where they were buying up billions of dollars of bonds to show up the market. And it looks like maybe sometime next year that may come to an end. And when that does, the rates are going to go up. So if you want to get into some deals, now's the time to start looking at these. Less risk with vacancy. This is easy to compare to a single-family house or a duplex or a fourplex. If you've got a fourplex and you lose 2 of your tenants, you're 50% occupied. If I've got 200 units and I lose 2 of my tenants, it's just a little hiccup, not a big deal. I can still make my mortgage payment. But if you've got a fourplex and you lose 2 of your tenants, you're going to be able to make your mortgage payment, your taxes, your insurance, your maintenance, all of those issues. It's a little bit more difficult. So that's the reason we like the larger 150 units and above. If we get down 10 units, no big concern. We do work on that. We maintain all of our properties. We like to keep them anywhere from 95% and up occupied. The one I talked to you earlier about, Crystal Falls, we're constantly 98 to 100% occupied on that property. As I said also earlier, cash flow begins when escrow closes. We look for extremely good cash flow on our properties. We want to make sure that the day we close escrow that they make money. Baby boomers and echo boomers are renting in the masses. If you've heard the news, you know what's happening. As the interest rates start rising, the affordability of homes are going to go to the wayside and people are going to have to rent. Apartments are one of the easiest things there is to get financed. If you're looking at a single family, multifamily, duplex, something of that nature, it's a little bit more difficult because they require you to sign on the dotted line and be responsible in case you can't make your mortgage. They're going to come after you. And in multifamily of $3 million and above, most of these loans are non-recourse, which means that if the property goes south and you can't make your payments, the bank will take the property back, and unless you've done something bad on the property, they won't come after you. But if you've taken the money and put it in your pocket and not paid, there's bad boy carve-outs in these loans. But in general, non-recourse, they won't come after you. Professional third-party property management team. Karen touched base on this tentatively. The third-party property management companies are a godsend. Nor do I want to be left in my bed at night having people calling me because the toilet's leaking. They had a broken pipe overnight and their apartment's getting flooded. That's the reason we have the third-party managers, because they take care of all of this.
Let's talk about the fee differences.
The managers, the people that live in these complexes, and generally do not know who owns the property. They know that the managers are down there, and that's their first point of contact, and they always take care of that. It's a small fee on these larger properties, generally 3%, maybe 4%, depending on the size and the income. You get into single families, those can be 10 to 12% that management companies charge. So we're looking at economies of scale here. With 3%, they take care of everything. They do all the book work for you. They take care of the payroll. The people that are on site are the employees of the management company. So we have no management. I mean, we have no employees. We have no headaches from that standpoint. We manage the managers. We constantly go over them. You going to talk about the
We'll talk about
monthly?
Yep.
Okay.
We'll talk a little bit about that on there. But right now I want to talk about which investor are you? I've been both. I've been involved in a single family. This is not a picture of me, but I can relate to this completely. I've worn the overalls, had the glue on me, been full of bumps and bruises and everything else, but I much prefer the diagram on the right. I prefer much more spending my time shopping. Time is very valuable. It really doesn't matter how much money you have. You can't buy more time. It's all about enjoying life. And are you enjoying yourself getting calls about the tenants' toilets and trash? Wouldn't it be much easier to let a property management company oversee all this so you don't get caused to be called in the middle of the night like Stan was mentioning, and you can start enjoying life and increasing your revenue? I mean, the money that we're going to be talking about later on it's very nice yield that we're able to provide with people with virtually no work on the investor's part at all. You want to talk a little bit about the single-family differences?
Yeah, I touched on base on it there pretty much. Again, I've done single-family, and I've done multifamily. I've done small multifamily, and I very much prefer the larger 150 units and above. It takes less time. Actually, it's a lot less time than it is the hassle of doing a single family or a multifamily or excuse me, a fourplex, which, you know, I understand you have to start somewhere and you get your feet wet in these areas, and then you progress upwards as we have over the years. But I definitely much prefer the multifamily over a single family. You've got one mortgage payment to make for 150 units, and not if you've got 10 single-family houses, you've got 10 mortgage payments to make. You've got one insurance payment. You've got one everything on a large 150 unit.
As he's mentioning, you got one property to go visit, one nice apartment versus running around town saying all 10 or whatever you've got, one roof to maintain, one landscape crew to be paying, one pool service. But the nice part at the end of the month is you get 150 checks from a multifamily, and you're not scrambling around all your single families trying to get their checks and track them all down, and are they vacation, are they mailing them to you. So the convenience of the multifamily is a huge time saving along the way, and as he was mentioning, you get better buying power with the bigger properties. If you want to buy furniture, if you want a landscape, if you want new air conditioning units, you get a much better deal when you're buying them in bulk for 150 unit property versus individual houses here and there.
Again, with the management company on a larger multifamily product, you've got people that are on site daily. You got management people, you've got maintenance people, and we get a Monday morning report every Monday detailing our occupancy, the traffic. They're letting us know what maintenance occurred during the week, how many calls they had, is there any outstanding issues on the maintenance calls. So they keep us really informed, and we require that to be in our office every Monday morning on every property so that we can take a quick look at it. And if we see anything wrong, then we can address it immediately.
Somebody's asking me, how do we find our property management companies? Every property is unique. We've used a few different property management companies. We want somebody that knows the area very, very well. We want somebody large enough that has all the resources behind them to get the best buying power and the best experience. We want someone large enough that can cover vacations, sick time, replace employees that they need be, and not leave us hanging by not having people to be able to take care of our property if things are going on with personnel issues there. To qualify the management companies, it's about interviewing. We talk with other property companies that they work for. We check out their other properties. We go to apartmentratings.com and see how tenants are reviewing a property, because this does reflect on the property management company. We spend a lot of time doing due diligence with property management companies to make sure it's a good fit for our property. Where are we on here? Oh, this is the best part.
How raising rents can create huge values for you. Now, this really applies to any type of commercial real estate property. If you want to, we've got an example here. If you raise the rents $10 a month on 150 units, you've just increased your cash flow $150 a month. Now you multiply that times 12 months, you've increased your income $18,000 a year. Now, using a simple 10 cap, you've increased the value of that property $180,000 just by raising your rents $10 a month. Now, you multiply that over the whole period, and generally 5 years, you've increased the value of your property, of your asset, by $900,000. Now, that's just increasing it $10 for the very first year. And you can imagine what that would do if you did that every year for the whole period of the 5 years. That's one way of creating value. Another way is that we always like to look at existing contracts on the property when we're analyzing the deals. And you should do this also. Look at the contract services, landscaping, laundry services. There again, a lot of times there's a laundromat, and 9 times out of 10 those units are leased, and the leases come up and they're just sitting there. But if you go in there and talk to your laundry people, they will give you an allowance, a remodeling allowance, and they will bring in new machines. And depending on the size of the property, this could be anywhere from $5,000 to $10,000 they'll write you a check for. That's just extra money. And the same thing goes with TVs. Karen, you did that.
Yeah, we did.
On our last property.
Our last property that we did, they did not have a cable TV. Everybody kind of did their own thing. There were satellite dishes here. Some people had AT&T. Some people had Cox. Some people had this and that. And it was kind of scattered. We knew when we wanted to go in there, we wanted to get rid of the satellite dishes hanging off everybody's balconies and roofs. That we know we needed to do. But when they had this property, they really never set anything up. So we worked out an agreement. I talked to several cable companies and worked out something with, this one happened to be AT&T U-verse on this property. Other ones have been different. And we agreed to market theirs only, meaning we would have their brochures and we would tell our tenants about AT&T U-verse. People could choose whatever they wanted, although the dishes were out of question, and they could choose whoever they wanted. But if they did choose the AT&T U-verse, we got a percent of whatever they signed up for. We got anywhere from like 5 to 8% of whatever services paid for every month. So to this day, we're getting between $500 and $700 a month extra cash flow just by going into agreement with AT&T U-verse. And initially, when we signed on the dotted line that we would do sole marketing for them, they offered us was $1,000 a unit.
$200 a unit.
Sorry.
Which on 165 units, they wrote us a check for $33,000. Again, extra money to put in your pocket, put back in your reserve account, or put back into the units themselves and upgrade.
All we had to do is require a 5-year marketing agreement with them, but people could still pick whatever service they wanted. So along with the big lump sum in the beginning, we get a nice cash flow of about $600, $700 a month along for the next 5 years. And when we go to sell the property, the next owner, or if this one expires in 5 years and we still have the property, we can renegotiate and do this whole thing again, maybe with a different company and a better rate. So there's a lot of great ways to increase value other than this really simple raising the rents $10 a month, which Stan talked about. So there's great ways of doing value pay other than big buying and flippings and rehabbing. It's amazing what you can do. Let's move on a little bit here. We've had some people asking me about the focus on Texas. We just happen to have a slide about why the Texas market. This is kind of a picture here of the Golden State, California, which is where I'm sitting right now. And there's Texas in the background with his jet ski. We started focusing on Texas as watching a whole lot of areas. The population growth seemed to be the most consistent around the United States. It was close on some areas, but that's one of the factors we looked at. One of the other ones we looked at is the unemployment. When everything was kind of going crazy on the unemployment, Texas really was stable. They weren't going up and down like other places were doing. The diversification in Texas is great. There's the shipping out there, there's energy, there's lots of hospitals, there's a space center. So you've got a lot to draw from. So if one area kind of goes down, you've still got other areas that are really going to sustain it. They also have got the most stable job growth with diversification, as I just mentioned on there. And the business climate is very good in Texas. If you look at all the places where people are moving, the businesses Unfortunately, a lot of them are moving out of California. For those that have businesses in California, perfectly understand this. And Texas is just booming right now and just bringing everybody in there as fast as they possibly can. And the businesses are very happy with the climate out there. And the rents have always been stable, as opposed to California, Nevada, Arizona, Florida, where the rents were just climbing like crazy, and then they collapsed after a while, and everybody had to give concessions and try and get people back in. They were given 2 months, sometimes 3 months free rent to get in there. Texas never really had that. They didn't have the big bubble, and they really stabilized, and I like that consistency. I'm not about speculation. I like to kind of be able to foresee things and not second guess.
Again, one of the reasons is Texas, we found that you get more bang for your buck. You can get in the Texas market on 100 unit complex for anywhere, it depends on a C or B property, anywhere from $25,000 upwards to $75,000 per door. And in California, you can't even do that, not even close. You're looking upwards to $300,000 to $500,000 a door. So obviously, more bang for your buck.
The per door, as Stan was saying, a lot of it's a term a lot of people use to explain how much a property is. It's per door, is per apartment unit, is how they kind of like $10 or $1,000 a door, and it's 100 units. That's kind of how they use it in the lingo for buying multifamily on there. So let's see how we're going here. We're not too much more further in here. Stan's going to talk about our acquisition criteria, and since he's in charge of acquisitions, I'm going to let him talk about it.
As I said earlier, we like the 150 units and above. Is the reason we look at this is because in the B properties, we like to stay under 20 million per property, preferably the 15 to 18 million range, because you get above that, the institutions come into play, and it's hard to compete against them because they're looking for somewhere to park their money. If they're happy at 3-4% return on their money, where I'm not even close to that. I won't consider that. So I've got to stay under their radar and stay in the under the $18 million range. We look at properties in the A and B locations. If you're familiar with a property with multifamily at all, you know there's a rating system, A, B, C, and D. That's how they value properties. A is a little bit newer property. B is in the mid-80s to mid-90s. C is more your blue-collar, lower end, and the D's are the drug addicts and everything else that you want to stay away from. So we like to stay in the B properties, is where we make our most money in.
Can you talk about any of those things?
The positive cash flow with value add we talked about, as far as cable TV, laundry, some other things that we look at in the expenses. Where can we tighten up the expenses when we're analyzing deals to make the property more valuable for us coming in?
Okay, got a few more slides here, and then we're going to take a lot of questions, you know, especially after Karen talks. She's got a lot of things to say. We have a fantastic group of professionals that we've been working with for years. The real estate brokers, we keep in constant contact. We find the properties that a lot of people don't know about. Since we're out there actively buying, we like to get a lot of these before they go out to everybody. Stan keeps in constant contact with the mortgage brokers. We know what's going on with the interest rate. We know where we can get interest-only loans. We know which areas the lenders like, which areas they don't like, so we stay real close with them. We work with a couple of different SEC attorneys that are phenomenal in drafting up all of our documents that the investors look at and what is filed with the SEC. We work with the state attorneys that help some of our clients with their trusts, LLCs, how they want to buy into one of our syndications. We work with a real estate attorney in Texas or whatever state we're buying in. He reviews all contracts, and he represents us during the entire escrow process to make sure he's looking out for our best interest. And of course, our property management company is a big part of our team that we look at on here. A little bit on how our investments are structured. As I mentioned, we're under a syndication, and we do what's called a private placement memorandum. That document, a PPM, as some people call it, it basically describes the property, the investment objectives, and how it's going to be structured, when you're going to get distributions, when we anticipate selling it. The operating agreement describes how the LLC that's buying the property is going to be organized. Who's in charge, who's second in command, and that has to be filed with the government also, and that's organization. This will also show individual ownership of all the investors, what percent they are ownership in the property. Whether you come in with $100,000 and you're 2%, 4%, every property is a little bit different, but it'll all be spelled out on this, exactly what your percent of ownership is on this deal. And the attorney files a regulations deed with the SEC. That's their job. And as I mentioned, the equity investors, you own the property through the LLC. The LLC is actually on the title when you buy the property. Some of the advantages of multifamily syndication: you have a lot less risk with a property history. You can look at the trailing 2 years financials, so you have an idea of what's been going on with the property, what their income, expenses, have they had major repairs. You can get a lot of information on 2 years of all their itemized billing and what their income has been. And it's much easier to predict rent increases, see how they are, how they've done in the past. You can compare to other properties around the area. You can find out more about the commercial areas. There's a lot of apartment associations that can give you an incredible amount of money on different little pockets within a city. Your investment is backed by the equity of real estate, so it's something tangible. You can see it, you can look at it, you can go down to the property, talk to the management staff, talk to the leasing agents. This is your property. If you're a buyer under the LLC, this is your property that you can go down and see. And if you want to take a vacation to Houston or Fort Worth or wherever the property is, you can write it off on your taxes as visiting one of your properties. You're also under less risk by buying in an LLC rather than holding the note personally. You're protected by the LLC. And again, the professional property management team, no employees. This is really nice. The professional property management team provides us with financial reports every month. These reports are anywhere between 90 and 100 pages long, that they are scrutinized every month by people in our office and myself, and every little bit is they have to be able to answer to if we don't understand something on them. They include trailing 12 months. They include where our escrow balances are. They include comps in the area, a rent roll, who's renting, who's late, what type of concessions. We get everything on there. And again, as Stan was mentioning, the non-recourse loans, the lenders are very picky about these. They want to make sure you're going to succeed. So they're going to scrutinize this property with everything they've got to make sure that they're not going to lose money, which is another set of eyes to look at everything for us and make sure you're protected, in doing your property there. If you're investing in a syndication with a group, what things you should expect? You should expect a monthly executive summary. This is something I provide as the investor relations, and I explain what's going on, what's our income, what's our expenses, how many people have come and visited the property, what's our closing ratio, which should be about 30%, what's our occupancy, how our expenses, have we done any capital improvements around there. And again, full disclosure and transparency. These 90-page financial reports that we get every month are fully open to any investor that wants to look at them anytime, any place. I tend to send out summaries because people don't really want to look at all 100 pages, but they're always available. If people want to know where their money is being spent, it's all right there. And again, fully compliant with all SEC guidelines. This is why we have an attorney hired to take care of all these things. And we personally invest in every property we own. We personally put in anywhere between 10 and 20% of the equity required. We want the property to succeed. We've got money in the deal. So that kind of gives you a little bit of, we have skin in the game, and we're taking the same risk as everybody else, probably more, because we have more money into the game than anybody else probably would. Stan, you want to talk about... Okay, well, here's an example. If you took a $100,000 investment, let's say you're going to sit with it for 5 years somewhere. If you put it in a CD of 1.25, which I know there's not that many of them out there, but I do see them, you're going to walk away with an extra $6,250 in 5 years. If you put it into an IRA, you found something spectacular and you're making 2%, in 5 years you're going to have an extra $10,000 to walk away with. If you put it into the stock market, you're going to have, who knows? You could lose it all 100,000 and be back to zero, or you could make a killing and make $500,000. Who knows with the stock market? But typically in a single family syndication, some of the ones that we work out, you walk away with an extra 100,000. This includes the distributions, which is when we pay you checks. We do it either 4 times a year or twice a year, depending on the property. It includes the checks you receive all year, plus the bump at the end with the equity and the extra money you've recaptured at the sale. All that included together would be included in this extra 100,000 you'd walk away with on top of your initial investment of the 100,000 invested. And we've come to the end of ours there, and we have the lovely Karen Hall sitting here ready to give you some great information. And then we're going to flip it back and have some questions and answers for everybody's got any. So I'm going to go ahead and throw this over to Karen.